What's going on, everyone? Today is March 10th, and it's been an absolutely wild ride the last 8 to 10 days. So I'm going to walk you through everything that's going on in the market. This will be a little bit longer rate update than normal because we're going to talk about a lot. We're going to talk about conventional mortgage rates and how they've been impacted by the market, by the coronavirus. It is not what the media is saying, and I'll show you why the media is wrong. So we're going to jump into that first. Then we're going to talk about jumbo interest rates and how in many cases, jumbo interest rates have actually increased, not decreased. And then we're going to talk about the Fed rate cut that happened last week by 0.5%, what that means for mortgage rates, and what it means for the Fed rate cut that is coming this month. They already told us they're probably going to cut by 0.5%. So what happens when that happens? That's everything we're going to cover in this video. Let's start off with conventional mortgage rates. Let's talk about what the market's doing. The 10-year Treasury hit absolutely new record lows yesterday. It was down below 0.5% yesterday. It's already moving back upward, which means rates would be following that for the worse. So I've always told you guys, keep an eye on the 10-year Treasury, follow it on your stock app, because it's the best gauge you have of information of what mortgage rates are doing. But I've always said, it's not a perfect science. It is not always spot on. And the last week is exactly that example. So I'm going to jump into data. I'm going to show you what the 10-year Treasury did. This is all coronavirus. This is nothing else. The impeachment didn't have the impact on the market like this. Saudi Arabia oil field bombing didn't. Scare of Iran war didn't have the impact. The coronavirus, which is basically a fever, a cough, and shortness of breath. Normal flu symptoms are worse. That is what's caused all of this. That's what kind of brought the market to its knees over the last week. So let's talk about why. Let's look at the actual data so that you understand why these things are happening instead of just listening to the media. Because unfortunately, more and more often, they're wrong. They just make assumptions, throw it out there, and we're all supposed to believe it. So let's jump in, take a look, and we'll go from there. Okay, so we're going to start off looking at the 10-year Treasury. And so we're doing basically a 3-month look back here. So you can see that the 10-year Treasury was hovering at about 1.8% for a while. And then at the end of January, we started to get these rumors of this virus in China. And the 10-year Treasury started to move down. And remember, 10-year Treasury going down is a good thing. And then it subsided. It was like, okay, this isn't that bad. China's getting things under control. And you saw the market mellow out right here, about 1.6 to 1.5. And then all of a sudden, 2 weeks ago, just pure mayhem and chaos as it spreads globally. So the 10-year Treasury has just been diving. And then yesterday, we saw the 10-year Treasury hit an all-time low. 1.4 was our all-time low before. So this has all been an all-time low. But to get down to under 0.5% was crazy. And the market actually halted trading. So you look at this 10-year Treasury and you're basically like, okay, if back here, mortgage rates were like 3.625, 3.75, and now they're down to here, that should mean they're in the twos. That's ultimately what the media was doing. They're looking at the 10-year Treasury and making assumptions to say, oh, because the 10-year Treasury is here, that must mean mortgage rates are here. Let's just tell everybody that. It's not actually what's happening. So now I'm going to show you why the 10-year Treasury is not an accurate gauge of what's going on with mortgage rates. Let's look at mortgage-backed securities, which are not publicly available. I pay to look at them so I can make really smart decisions for you guys and show you how the markets work so you can choose your proper interest rate and get the best rate. So let's look at those. All right, so here are mortgage-backed securities. This is inverse of the 10-year Treasury. As this is moving up, think of it as better. Up means better rates. When mortgage-backed securities increase, rates improve. So same pattern, right? We saw this trend, what's this coronavirus thing that's happening? Here's where that started at the end of January. And then it flattened out. Okay, it seems like China's got things under control. They didn't. And right when the 10-year Treasury went down, mortgage-backed securities did the same thing. But you can already see it has not been as dramatic. And then if you look at the last week, where you just had kind of this continual cliff with the 10-year Treasury, you can see that this is today. So today things are getting worse, right? This is going down, which means worse. But here's yesterday. So if we look right here, very apparent line. So this ceiling that we were hitting was a floor for interest rates. Rates could not break below that. And we hit it yesterday. Yesterday it tried to go lower. It went all the way up to 103.5, and then it immediately bounced back down to this resistance level. So yesterday, Friday, Thursday, Wednesday, Tuesday, Monday, rates were all roughly the same. You can see that ceiling. Think of it as a floor for mortgage rates. Rates were the same. They've been the same Monday of last week through yesterday. They're starting to get a little bit worse today because This can't last forever. And that's what I've been warning everyone about. I've been telling everyone who is looking at refinancing or buying, this window will close abruptly when it closes, because the only thing that's bringing it down is the fear of the coronavirus. It's not even the coronavirus itself. It's the fear of what could happen. So as soon as that gets under control, rates will move back up. So you need to be really aware of how short-term this can potentially be. Now, it's amazing to see these rates holding as long as they have, to be this low for a straight week with relatively little volatility with mortgage rates, regardless of what you saw in the market. This is a good thing. Now, let's talk about jumbo interest rates. Jumbo interest rates have not improved like these rates have, like traditional rates have, and that is because it doesn't follow the market perfectly. Banks create their own products. That's what a jumbo mortgage is. A loan amount above $765,600 in, I'm going to just focus on Bay Area counties for now. The county loan limit will be different dependent upon county. But in the higher cost areas of California, $765,600 is the limit for those specific counties. You go above that, it becomes a jumbo loan. The banks completely control those. They create their own products, their own guidelines, their own rates. Well, that becomes supply and demand. So when they have all these people flooding them, right? So let's pretend you're Wells Fargo and Chase. People are flooding you to refinance. We can't support this volume. We can't handle this demand. We got to bump our price up to slow things down. So that's exactly what they did. They've moved their interest rates up on jumbo loans to kind of slow down volume because they can't handle it. They can't, from a capacity standpoint of underwriting loans, drawing docs on loans, funding loans, they can't handle it. And there may not be enough funding to handle it either. So those are the reasons we see banks move rates up in those cases. Is for two quick examples. One client coming to me last week to refinance. She went to Wells Fargo to start. Wells said, "We're too busy. We can't help you." That was kind of it. They didn't even give her a rate quote. They just said, "We're full." And they cut her loose. Chase, had another client go to Chase. She was at 4.625 when she bought her home in 2018, went to refinance to these historic lows. Chase quoted her 4.375, and we were at 3.5 for her specific loan scenario. So where we haven't had to move rates out because we have more capacity, the jumbo banks have. So you got to be aware of that as well when you're looking for rate quotes. So that's jumbo loans. So now let's talk about Fed rate cuts. So Fed rate cut last week was 0.5%, which is substantial. Now, every time the Fed cuts rates, I get a million phone calls asking what that means for mortgage rates. Doesn't mean anything. And the example I always give is think of it like a stock. If you owned Google stock and today Google said, we're going to have huge layoffs and massive losses come June, would you sell your stock now on that negative news, or would you hold out until June? You, along with everyone else, would most likely react to the news, to the announcement, and sell. And Google stock would drop sharply as a result of the news. That's the same thing that happens with these Fed rate announcements. They always allude to what they're going to be doing at their next meeting. So we knew that they were going to cut rates last week. And that's why on Tuesday, we didn't see a change in rates whatsoever from that, because we already knew it was coming. They've already announced or alluded to a 0.5% cut this month. So when that meeting happens, if they cut rates by 0.5%, we're not going to see it because the market's already accounted for it. It's already built in. We reacted to the news. So remember that. Now, the good thing about these Fed rate cuts is if you have an equity line or you're looking at putting less than 20% down on a property, you're going to use an equity line or a second mortgage to do so. Those rates are directly impacted by these Fed rate cuts. So what that means is if you had an equity line last week, that rate went down 0.5%. Your next mortgage statement in April will go down 0.5%. If they cut again this month, that means we're going to get another 0.5%. So the prime rate is what equity lines are based on. That was sitting at 4.75%. Now it's sitting at 4.25%. And if they cut another 0.5%, it'll be sitting at 3.75%. Equity lines are always based on that prime index plus a margin. So that's how the equity lines work. So that's good news for equity lines. All of this will subside relatively quickly because it's all fear driven on this coronavirus. This isn't the zombie apocalypse the way we're treating it. So I do expect rates to unfortunately bounce off of this and go back to where they were a few weeks ago, which was still record lows. If you're getting 30-year fixed rates in the threes, you're sitting pretty. Historically, that's happened twice, well, now 3 times in the last 51 years. 2016, 2012, and now. That's it. It's the only time you've seen rates under 4%. So That's our rate update for today. If you have any questions, comments, concerns, feel free to leave a comment right below. Call me, email me, text me anytime. It's really important to me that you guys understand how all of this works, because I want you to make very educated decisions when it comes to your home financing. Whether you're refinancing or purchasing, you have to make sure you create the right solution, and the way you do that is by being very well educated. Let me know how I can help. I'll talk to you soon. Cheers.